Well, hey there, everyone, and welcome to the VIP Trade Room with Roger Scott and Matt Horton. Now, today is Tuesday, January 20th, and my name is Raleigh White, and I'm coming to you live from a nice, sunny, but chilly day here in Austin, Texas, and I'm going to be your moderator today. Now, in today's session, Roger is going to be covering a range of important topics with a special focus on trading for income. First of all, he's going to lead off giving us a midday market analysis and what his top watch list stocks are for this afternoon. He's also then going to talk about what are credit spreads and why they give you an edge. He's also going to share the upside of credit spreads versus debit spreads and how risk and reward are capped to your advantage. He's then going to show us and tell us about diagonal spreads and why he likes to use them during the earnings season like the one we're in right now. And as a special bonus, we're going to see a live demonstration of him finding and then placing a credit spread in the live markets. Now, if you've got any questions during Roger's presentation, please type them in the chat window and we'll address them periodically throughout the session so as to not interfere with Roger's presentation. And remember, folks, I have opened the chat room to everyone, and we do have some ground rules. Always, folks, if you're going to be posting, be kind and supportive. Number two, please keep to the topic. Also, folks, no political discussions allowed here whatsoever. And also, keep your side conversations to a minimum, folks. This is not a chat room, right? We're here to listen and to learn from the education that Roger's going to be sharing with us, because after all, he's here to give us an edge and to become much more confident and consistent in our trading activities. Now, for those of you that were with us this morning at 8 o'clock for Roger's pre-market briefing, there were several catalysts on top that we needed to be aware of. First of all, in the mag sector, we noted that Google and Amazon were both down 3% coming into the open. With regard to chips, we noted that AMD and Marvell were down 2%. On the finance front, we noted that Key, FTIB, and USB were all going to be releasing their earnings before market open. In industrials, we noted that 3M, Fast, and DHI were also going to be releasing their earnings before market open. And then on the international front, we noted that the Euro stocks were down 1% and Nikkei was also down 1%, both not giving us much, if any, tailwind coming into our open. And then with regard to crypto, with the lowering, with the Bitcoin prices falling, it was also bringing down some crypto stocks, most notably Coin was down 4%. But I know that MSTR and Mara were also down coming into the open. Now, a lot of people will ask me the question, Raleigh, why do we even focus on these catalysts? What does it really mean? Well, from Roger's perspective, he believes this. If there's either information that is known or will become known during the today's trading session, but it's not yet priced into the market, those are volatility flashpoints. And if we're going to be looking to trade stocks, for example, in the mags, the chips, and finance, industrials, or whatnot, it's important for us to be aware of what's going on in those sectors. And so, from that standpoint, we always look at the big picture first and discover and learn what are the catalysts we need to be aware of on any given day. Now, as far as Roger's pre-market stock watch list is concerned here, folks, once again, these are the large caps that he's got his eyes on. We noted that there were 10 shorts and there were 8 longs that were currently on his list. Now, he also provided some very, very interesting information to us. With regard to the shorts, he's basically saying, guys, look, be careful about these because the market is down coming into the open, okay? And shorts may be already oversold, so be very, very careful. As a matter of fact, his preference was to focus a little bit more on the long stocks. But he also said, be careful about these as well, and make sure that you're buying longs that are actually strong. Okay, don't look for bargain hunting. Look for those that are actually strong because essentially you want to see stocks that have recovered from their losses, are bouncing back, and they're moving higher as those that we want to focus on. And the thing is this, folks, if you're with us in the pre-market briefing, and I hope you are, Roger brings up, for each one of these tickers, he brings up the chart and he tells the story as to what the chart is sharing with us. And once again, because they're on the watch list, it doesn't mean that these are automatically trades he's going to take. What he means is that they are setting up for the potential to be trades. And he usually gives us an update here at the midday. And then he also does another revision towards the end of the day when he looks for stocks that he might want to swing. Now, as far as Roger's pre-market thoughts are concerned, folks, we did notice that the futures markets were all down significantly coming into the open. And the catalyst there was, Trump's saber rattling over, increased tariffs onto European countries with regard to Greenland and so forth and so on. So the markets were, responding very, very negatively. He also pointed to the fact that the put-call ratio was unbalanced, actually favoring the calls coming into the open, and he expected that to turn around. He also shared with us that the VIX was up sharply above that critical 20 level. That's a level at which, we have to be concerned that is volatility going to keep on moving up, which would bring downward pressure on the markets. He did show also that stocks that are above the 20-day average were slowing down, but those below the 20-day average were accelerating. And this is one of those key momentum indicators that he was going to be watching all day long. He did see that the sector rotation was shifting back in favor of defensive stocks, as those interest-sensitive speculative stocks are moving much down, lower on the list, and that the bonds, which were basically moving lower, were leading the SMH, the QQQ, and the MAGs much lower into support. Now, those areas of support that he was talking about, whether it was the 8-day, whether it was the 50-day or the 100-day, he expects those support levels to hold, but he expects that the market is going to move down into that. He, concluded by basically saying, guys, look, let's be careful. What we saw in the futures markets today, he believes, was an overreaction to what was going on, and there should be some recovery off of that. May not be today, but he expects that there's going to be a recovery. He basically said, wait for a breakdown into support. He expects that the major indexes are going to come down to key areas of support, level off, and then start to move a little bit higher. So he said, be patient, wait for that breakdown to happen. And also, folks, resist. By all means, resist fear of missing out, because that's one of those things, that's one of those emotional things that can really hurt you, especially in these times. So Roger's, put together a terrific agenda for us today. We're delighted you're with us. It's Tuesday, it's a holiday shortened week, and he's got a great agenda on tap. The focus is going to be on trading for income. And he's going to begin by giving us a midday market analysis and what stocks are on his watch list right now, midday. He's also going to talk about credit spreads and why they give you an edge. He's going to talk about the upside of credit spreads over debit spreads and how risk and reward are capped to your advantage. He's also then going to share with us what diagonal spreads are and why he particularly likes using this strategy during the earnings season. And then as a special bonus, once again, provided things are setting up, he's going to demo a live credit spread in the live markets. Now, if you've got any questions during Roger's presentation, please type them in the chat window and we'll address them periodically throughout the session so as to not interfere with Roger's presentation. And also, folks, please remember this, okay? The chat room is open to everyone and we have some ground rules. Always be kind and supportive in your posts. Please keep to the topic. No political discussions allowed, and keep your side conversations to a minimum, okay? This is not a chat room, folks. We're here to listen and to learn from what Roger is sharing to us, and because he's here to give us an edge and to help us all become much more confident and consistent in our trading activities. And with that, let's say hi to Matt. Matt, good to see you, my friend.
Hey.
Roger, good to see you also. Welcome back. It feels like a Monday. I know it's a Tuesday.
It does feel like a Monday. It really does feel like a Monday. For all intents purposes, it is a Monday for me.
Anyway, well, I hope you had a good weekend. I certainly had a great weekend. You know me, I'm a big fan of football, and boy, was there some good football on the TV. But here we are. We're back in the markets. Our president, my gosh, he, I don't know, buddy, but I tell you what, I woke up this morning early like you did, and I opened up the futures markets, and I'm like, what the heck, and And here we are. So, and I tend to agree with you, Roger. When these things happen, these can be overreactions, but they're pretty startling, and it
Yes.
really is a drag on things. But I thought your point to everybody this morning was well worth it. It's like, look, guys, be patient, be cautious, recognize what's coming on. And I think the biggest takeaway from me from your briefing this morning, Roger, was an expectation that the markets are going to fall into critical areas of support. Wait
Yes.
for that to happen. Wait for them to level out, let
Yes.
things shake out, and move up. So patience is the name of the game. Anything changed for you this morning? Here we are,
Um,
midday.
no, no, not at all. Not at all. Actually, yeah, let me just share my screen. No, no, pretty much exactly as I mentioned to you guys last Friday and earlier today. Our We have 149 stocks now, not 440 trading above the 20-day high.
Yeah, you figured
Remember we
that.
talked about it this
Yeah.
morning? We talked this morning about the SPY uh, coming to the 50-day moving average and staying in this area for a while. Now, I'm going to tell you guys what I think. And and again, maybe I'm wrong, okay? Um, but I think we're going to stay here. A lot of folks think we're going to go up. A lot of folks think we're going to go down. I don't think we're going to do either. I think we're going to stay here, build a base till we get a decision from the Supreme Court. Once we get the decision from the Supreme Court, which is going to be a negative for our president, we're going to rally like there's no tomorrow to the 700 level. We've already demonstrated the market really does not like these tariffs. So as soon as we can get past that, and actually the funny thing is, this decision would be a double whammy. I never thought of it that way, but it would be a double whammy because on one hand, uh, it would show that we're not going to have tariffs, and B, this whole tariff thing with Greenland using tariffs against third world countries because they don't want to go with him on Greenland. That would also dissipate because now he has no control on using leverage on tariffs anymore. And again, as I've been saying for the last 100 days, that what our president is doing is demonstrably showing to the Supreme Court that these tariffs are being used as a tool against foreign countries and not as an emergency measure for the U.S. So again, I'm just saying that if he's trying to pull a fast one on the Supreme Court, his actions and every word that comes out of his mouth can be used by the Supreme Court to show that he does not intend to do exactly what he says he intends to do, which I think his lawyers must have told him at least 1,000 times, but he just doesn't listen. So I'm just gonna stay out of it. I'm gonna leave. I'm gonna just focus on the market. But I think what's going on right now is straight out of a satire. Um, I was watching a movie called In the Loop or something with James Gandolfini last night from 2007. It's a political satire. And honestly, what I'm seeing right now in real life matches exactly what I'm seeing in those movies. And folks, this is priceless. This is right out of a comic book, okay? But anyway, here we are. We're at the 50-day moving average. I think we're going to stay around the 50-day moving average. I think that we're going to get some resolution on this tariff sooner than later, and I think we're going to make a higher high, and I think we're going to fill the gap. Now, if the Supreme Court doesn't come out with anything in the next several days, it may take us slower, but I think we have a pretty good support at this level. I think the mistake a lot of folks are going to be making right now is trying to say, okay, we're here, we're going to go up, we're going to go down, and we may not go anywhere. And that would actually be the best possibility because implied volatility, which is a little expensive right now, would have a chance to cool off and start coming back down again. Options are really expensive right now, really, really expensive. So, um, so I do believe that. Yeah, I do believe that things will cool off. What I don't like is the bond market. But even if you look at the bond market is rallying all day today after the open. So it's telling us that this is an overreaction right now as
Mhm.
well. So to me, it looks like we want to start coming back up, filling this gap. The QQQ is actually holding up. Look at this. It went right to the 100-day moving average right here. That's the 100-day moving average, and it backed up. And now we're pinched between the 100 and the 50. If we can get our head, if we can get this hammer to get back above the 50, we'll be in good shape. Okay, we need to get this above the 50. As far as the SMH is concerned, we're already above the 8-day EMA. We just need to start filling in this more, a little bit more. But SMH is leading right now. Remember what I told you beginning of the year, actually Christmas. SMH is going to be back on top this year, at least for the foreseeable future. So, and gold is still coming up. I told you, wait till we get here to buy it.
Yes, you did.
I did. I did. I told everybody to wait till remember, we were up here and I said, wait till we're at least at the 8-day EMA.
Hmm.
And we hit that 8-day EMA right here. And now we're much higher. And I did tell everybody in the morning for about 1 day, 2 days. I told you guys to take profit here. I said, gaps are gifts, take profit, wait till it's back at the 8-day EMA to get in. I did. It's videotaped, it's time stamped, and I have about 300 people who are here right now who were there. So I did. I said it.
Oh, you were sharing that with us all last week.
I did. I was
Yep.
every day last week, and right there's your 8-day EMA right here. You had a nice opportunity to get in. Okay. So silver, on the other hand, is still up there and almost went to the 8-day, just a hair off. Well, I don't think, I'm pretty confident these are going to come off. So I think what we're seeing right now, is an overreaction. And I'm really glad that it's happening on a Tuesday instead of a Thursday or a Friday, so we don't have the over the weekend for more speculation and all these activities to Roblox to begin keying off.
Question just popped up here, Roger, if you want to give a quick comment, and
Yes.
that is with basically silver and gold being, arguably overextended, do you expect those to come back down?
Yes. Yeah. Yeah. Here. Yeah. I think we're gonna come right here. We're gonna come
So
right.
right there at the low of that channel. Yep. Yep.
Yeah. Yeah. Somewhere right here. Somewhere right here. In this vicinity. In this vicinity. Um. You know. Yeah. Somewhere right in this vicinity. I'm pretty confident we are. I'm pretty confident. I'm not. I'm not a little confident. I'm like a lot confident that we are. Um. Yeah, and I think the SPY is going to come up, but I don't think it's going to happen as fast as people want it to be. I think everybody's waiting for a reaction, and I think the market right now needs to get that a Supreme Court reaction.
Hmm.
One way or the other, the Supreme Court reaction is going to give us certainty,
Yeah.
you know. But I'm pretty confident based on what we saw 2 weeks ago when we thought it was going to come out, when all the retailers started just. Do you remember I showed you that candle? They
Yep.
were all just coming up, 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 and as soon as the Supreme Court says nope, just flattened out. I mean,
Absolutely.
everybody knows what the market wants. Everybody knows what the market wants, except our president. But
Right.
he's in his own world. Um, I've never seen anybody create so much volatility in this country for no reason whatsoever. But here we are. All right, let me give you guys stocks. I have a lot to talk about today. Um, Let me give you stocks that I'm bearish and bullish on. My suggestion would be to just hold off. Don't take big. A lot of people think they know what's going to happen next. We don't know what's going to happen next. This is a big move and we have to respect it, okay? Wait for confirmation, wait for us to trade above. Think about this. If you're right, and if we're all right, I think it's going to go up too, but if we're right, you've got all this room here. You've got all this room here, right? I'd rather be late to the party and get all this instead and risk this to get this. So
Absolutely.
hold off. You don't need to rush here. You don't need to rush.
Is
I'd
this
rather
one
be
of those situations, Roger, where you also look for that 60% recovery? I know when we see a big gap down like this and there's things that you look for, you're going like, hey, in the next couple of days, I know that things are back on track, but if we see a
well,
60% or so
we kind
recovery,
of gapped. We kind of gapped. We don't have that 60%, but it would be here somewhere. I would say yes, but honestly, I wouldn't even wait that long. I think if we
okay.
can get above
Yep.
today's high, I think we're in good shape.
Okay.
And look what's interesting. I want to show you how well these high volume candles work. Okay. Just take a look at this right here. Look at this high volume candle here, high volume candle here. you got the next high volume candle right here, this area. And
Yeah.
that's right about that 60% right here,
Okay.
that move. So I think once we get past this area, once we start flirting with the 15 and the 8 day, I think we're going to be in good shape. I think we have a lot of uncertainty here. I would be very disappointed if we broke this low, and I would be very pleased if we took out this high. And I'm going to start buying. I'm going to start dipping my toe in the water when we start breaking these highs, especially
Yeah.
if it's in the late of the day. But again, I think what may happen is we may be just kind of doing this, kind of sticking around here for a little while.
Okay.
I think what we need to do right now is I think we need to just be patient. Be patient. And a lot of folks don't like those words, but I think we need to be patient right now.
No, because we got money in our pocket and we're ready to spend it.
Right. It's
Burning a hole.
burning. Yeah, burning a hole in our pocket. Just let it be. Let it be. You don't need to do anything. Be the sharp shooting sniper. I've bought maybe like 30 shares of Albemarle this morning. I'm just dipping, just so I could keep eyes on certain stocks that I'm looking at. Not like, just like, hey, oh, okay, these are the stocks that I'm looking at. But I'm not making any commitments to anything as of yet, at all, whatsoever. Okay, so let's look at stocks that were short, and then I'll give you stocks that were long, and then I'll talk about income strategies, which are fantastic right now. Fantastic. Why? Because implied volatility is high. And when do income strategies work best? When implied volatility is high.
Hmm.
So I'm going to talk about credit spreads today. So you may want to start doing credit spreads right now over here, but not in the money over here. Okay, that's all I would do. I wouldn't go directional just yet. I would do maybe credit spreads. That way, if we stay around here for a few days, you will still get a decline in implied volatility. But I wouldn't go directional yet. All right, so let me give you stocks that I'm looking at. I'm looking at Adobe. I think institutions don't want to own this stock right now. I think it's pretty obvious. Look at this. Three high volume candles out of one, two, three, four, five, six, seven. Um, Volume above the average daily. This is selling pressure. This is institutional selling pressure. Don't kid yourself. Okay. And it looks like there's more selling pressure on the way. Hymns, remember hymns. So far, it's looking actually pretty good right now, but over time, we're below the 8 day. This is definitely a swing trade, not a day trade. Um, PayPal. Look at PayPal. Look at this. This is weakness. Weakness. Remember, I did not screen for earnings. Dell is breaking support. Not a good look. Not a good look for Dell. Um, Matt, when can you put those high volume bars in the Pro Trader dashboard?
I'll try to get that done today.
Okay. These fluorescent green, solid fluorescent green, and solid fluorescent orange, okay? Green for up and orange for down. Just use a 50-day SMA based on the intraday time frame, okay? For above over 120%, okay? You hear me?
Yep.
Above, okay. All right, let's continue. Dell. IoT. Look at that. It's a breakdown. That's what it is. Nice breakdown. TTD. Nice breakdown. What do all of these have in common? They're breaking below their channel. Lyft. I'd be careful with this one because you got the 200-day here. So if you're going to do it, this is your target. Okay. Lee. Lee looks like looks like it's turning over here. Snow. Snow, it's consolidating around here, but Not in a good way. It's not jumping up. It's consolidating and looks like it wants to break down. That looks like a pretty good short here on snow.
Man, speaking of snow, Roger, did you read about that 100-car pileup in Michigan
I
in
did.
snow?
I did.
My
I did.
God. Anyway, I'm
Amazing.
sorry. I just
No,
like,
no, it's okay. It's all
yeah.
good. Hog. I've always wanted a Harley. My mom said, if you ever ride a motorcycle, I'll kill you. And then after I got married, my wife said, if you ever get a motorcycle, I'll kill you. So
They're in cahoots, I tell you.
they're in cahoots. They're in cahoots. Well, keep in mind, I lived in Los Angeles. I think if I lived in like
Like in
Lake
the
Arrowhead
country or yeah,
yeah, I don't think they
yeah.
would care. Yeah, that's a nice breakdown right there. That is pretty. Look at that. I give you guys really good red meat, I'll tell you. Um, net, another one. Notice all of these stocks are breaking down. You're right. You're right. It is discriminating. I love motorcycles, but blame it on my wife. Net, nice. And Roblox. Now, notice broke down, came to resistance, and breaking down again. That's a low risk entry area right here. If it breaks, look at this. You've got all the way here to the downside. And here, if it breaks higher, you're out. You'll know that this trade is bad. You can negate this trade pretty quickly. You don't have to wait for too long. That's a good trade. It's also breaking down right now. I like this a lot, actually. The only problem is it's losing volume. It's losing volume. It's not gaining volume, which means still very good. This will be more of a scalp trade. But again, I wouldn't do scalps today because of this crazy market and implied
Yeah.
volatility. Um, anyway, so I'm just thinking out loud. I almost forgot that I was live with you guys, and I'm just like thinking outside
Stream
of
of
my head.
consciousness, yes.
Yeah, completely.
Yeah,
Which is probably a good thing.
it is.
I bought some of this stock for myself. Like I said, just 20, 30 shares just to keep an eye just to keep an eye on it. Um, and if it goes higher, I'll give you guys an alert. But I like this stock a lot. That's a nice look. Nice, real nice look. Um, Intel. Look at Intel. Looks very nice. Lunar. That's a nice looking stock. You know, looking at these stocks, you wouldn't know the market's doing what it's doing, right?
Right.
Look at Western Digital. Very nice looking stock. I'm giving you guys pure red meat. Pure red meat. This stock, Colgate Palmolive, it's been a bearish stock. It's been consumer staples, and it's finally breaking the 200-day moving average, which is really good. Really, really good. Baidu. Baidu to you too. All right. Baidu. PNC. We have people from all over our company. We're having a meeting here, and we have people working for us from all over the country, and there's quite a lot of people here. So if you hear a little noise in the background, they're having a Yelta conference over there. PNC. I think it's the first time they're having a big meeting at the new office. ST. Wow, look at this. Consumer staples. Consumer staples. The stock is on fire. I'm going to put an alert at the VWAP. Okay, that way we'll know because I'd like to buy the stock at the VWAP today. MSTZ, another one breaking the. And by the way, when consumers are starting to break higher, that's fairly defensive. Okay, just like that other stock I talked about, CL. Look at that, same type of look. BTU, it's a nice trend. ALCH. Oh, wrong ticker. ACLH. No, I got something wrong here. Hold on. write it wrong or something? AL. Hold on. A nice looking stock. Hold on.
Is it, Angie says, is it CELH?
No. That's a nice one too. I like this one too. See, oh, you know what, Angie? It is. Thank you. I appreciate it. Thank you, Angie. Angie's great. Yeah, it is CELH. I can't read my own writing. Yeah, very nice stock. I still like this stock. Actually, it's one of the few stocks I want to get on a pullback to the VWAP today. This is up. Okay. Volume's coming down, but still looking good. Okay. All right. So those are the stocks that I really like to the upside and I did say Lunar. Lunar was one of the stocks. It was the third stock on our list, Stacy. But I appreciate that. Thank you. Yeah. Thanks, Raleigh. Thanks you for posting that. Matt, can you hook me up?
Yeah.
Thank you. Okay. So let's talk about credit spreads. Okay. What are credit spreads? Why do you use credit spreads? When do you initiate credit spreads? Why are they useful? So the first thing about credit spreads is credit spreads are great. They're always good. You can always find a stock that has high implied volatility, but they tend to be exceptionally good when implied volatility goes near 20. Why? Because options are more expensive. They become 50% more expensive when they go from here to here. And when options are more expensive, we can get more money and less risk. We don't have to fly. Thank you. We don't have to fly as hot. We don't have to fly as close to the sun, and it's much easier to get premium out of them. Okay. Now, don't let me discourage you and tell you that you can't do credit spreads when implied volatility is here, because I've been doing them this entire time. But it gets a lot easier to do them when we're here. Okay. Also, when volatility rises, one of the reasons volatility rises is because we have increased uncertainty. And when you have increased uncertainty, markets tend to be more choppier. And we want on a credit spread, we want the markets to become choppier so that the stock doesn't go our way, because we're out of danger zone. So we just kind of want it to stay there. Okay. Now, I'm going to show you the difference between how I do credit spreads and how well, first, let me explain what a credit spread is. Okay. So let's take a stock like WDC. I don't know why I'm picking WDC, but let's just pick WDC. You see how it has a nice clean trend? Okay. What most folks would do is they'd go out, say 10 days out. This is 99.9% of all income traders, okay? And what they'll do is, and I'm not kidding when I say this, what they'll do is they'll sell a spread right here, okay, near 177. And if you go to oops, sorry, the other way. So they'll go like 10 days out and they'll go to like 177 and the premium is 165 and they'll sell the 165. They'll sell the 177.50 versus the 175, for example, hypothetically speaking. Okay. And they'll get like 30 cents out of this, 30 cents out of this. Okay. All right. They'll go all the way down here. All right. So for every $2 and for every $1.50 risk, they'll take like 30 cents. Okay. So if the trade goes your way, if this asset trades above this price, you'll be okay. You'll be fine. But if we trade down here, you're going to lose for every 30 cents you take in, you're going to lose $1.50. So you're going to lose 5 times what you risk. Okay. Now, fortunately, unfortunately, the way most traditional folks do credit spreads, they do what I call the 20-in-1 solution. Okay, 20-in-1, meaning what they do is they'll try to find where this asset is not going to go. And then what they'll do is they'll take 5% from a dollar, 5% from a dollar. Okay. And it works. It works really, really well. It works 19 out of 20 times. You will make money 19 out of 20 times. But at the 20th time, you will lose all the money that you've made during those 19 times. It's called walking up the stairs and fall. There's actually a name for it. It's called walking up the stairs and falling down. And if you don't believe me, just join any other traditional credit spread service and you will find that's what happens. Because numbers don't lie. You will keep making money, very little money. You won't have a lot of, for every like $1,000 you risk, you'll take like $100 income. Okay. And it's just not that fun. And I used to trade that way for like 3 months. I started a program that way, and I did not like it because your risk was, you were upside down. So what I did was I was like, you know what? I'm going to do this completely differently. So what I do is instead of going down here to do a spread, I go up here because I'm pretty good at market timing. So what I do is I'll find the trade right here. So let me show you what I would do. I would not go to the 177. I would stick near the 205, right? I would probably do something like this right here, right? Where, hold on, let me, actually, excuse me, like right here, like 200 to 197.50. So out of $2.50, we would get about, my idea is to take 40 to 60%, not 5%, 40 to 60%, 40 to 60%. So in other words, in something like this, and again, I don't always get it. And if I don't get it, I'll pass the trade. But I wanted to kind of show you in this case, we're getting about $1.50 out of $5. So we're getting about a third here. I would not do this trade. I would want to take right here out of $5. I would want to take $2.50 or $2.40. And what a traditional trader would do, a traditional income trader would do is they would go here and see this $5, they would take 50 cents. So if it goes their way, they'll make 50 cents. But if it doesn't go their way, they'll lose $4.50. Okay? So we don't want to do that. We want a risk to reward of 40 to 60%. Okay? So what I do is I'll keep writing income spreads right here, and they'll continue moving higher and higher and higher, and that income dissolves. So I was able to continue having an 80% win rate, taking 40 to 60% on my trade, and that's what it is right now. As a matter of fact, Matt, can you check our win rate and tell me what it is on weekly cash flow?
Mm-hmm.
Yeah. But that's what I try to do. I try to go for 40 to 60%. Now, what you do is it's very simple. You sell the expensive put, you sell say the 205, okay, and you buy one strike cheaper. So you take in $6.90. This is just all hypothetical. And you spend $5.30. And you're left right here with about $1.60. Okay? $1.60.
It's 79%.
I'll take it. That's close to 80. That's pretty close to 80%. I'll take it. And that's after how many trades, Matt?
114.
Yeah.
114. Do you see what I'm saying? So these guys have to go here to get an 80% win rate. I get my 80% win rate right here. And I'm not taking in 5%. I'm taking in 40 to 60%. Do you see the difference, folks? Now think about the math. Do the math. I'm 79% accurate, say 80 to make it easy, right? Now think about this for a second. What if you have accuracy of 80%, your losers are 50%, and your winners are 50%? Because think about this. If I'm risking 40 to 60%, I can't lose more than 40 to 60%. And I'm taking in 40, 60%. So imagine 80, just write it down on your paper, 80% win rate, right? That's 4 out of every 5 trades is a winner. My average win is 50%. My average lose is 50%. How does that work out on paper for you? Really well. Really, really well. Now, try this. 5% winner, 80%. Hell, let's do 90%, 5% winner.
Yeah.
Let's do 90%. That time you lose 95%. You lose everything you've made over the last 10 trade plus 10 more. You see the difference in the numbers? Big difference. So how do we do this? We always sell the expensive option and we always buy the cheaper option. So in this case, we would, and again, I'm just hypothetically doing this for you, okay? In this case, you would sell the 205 and you would buy the 200. Now, what's the worst thing? Let's say the stock went to the moon. Well, great. You make your money. You make your dollar. In this case, I wouldn't do this. This is not good. This is only gives us $1.60. I want to see it 250, 230 to 260. So this is not enough. But let's just say we got our 250 out of this. Well, I would want, if this went to the moon, okay, we make our money and we run. Nothing to talk about. But let's say that the stock, let's say WDC dropped to $100. It dropped from $200 to $100. Uh-oh. That means you can't lose past 200 because you own the 200 put. You see? So your downside is $5 from here to here minus whatever you took in. And as I said repeatedly, we take in between 40 and 60%. That's what we shoot for. Okay? So do you see that? So if this stock went to zero, you'd still only lose $2.50, thereabouts, half of the spread. It went up to the moon, you'd make full profit. But we have over 114 trades, we have almost an 80% win rate, and I take 40 to 60% each time. How much did we take today on the trade we did this morning, Matt?
We took 42%.
There you go. We did a trade this morning, earlier today, and we took in 42%. So if the worst thing happened, the world came apart, we would lose 58%, not 95%. Okay, not 95%. Okay, so just want to make sure you guys understand that. No, George, we don't buy we do bull put spreads is when we do it all on the put side, or let's say that the market, let's say that we think PayPal is going to go lower. Well, I would go to calls, and let's say that I don't think this is all hypothetical, but let's say I'll talk about assignments in a second. iPhone Liz, give me a minute. Right here, let's say 15, so 58. So let's see, 10 days out, 58. We would now. This is a perfect example of me not touching this. So let me show you this. $1 spread, right? $1 spread. What's the difference in the premium here? It's not even 20 cents. It's like let's see here. It's 16 cents. Well, 16 cents is not 40 to 60% of a dollar. Can't do this. I'd want this to be much bigger. So right here, for example, 55 versus 56, okay? A little bit in the money. 55 versus 56. We can do this right now for how much? 74 minus 9 is 65 cents. Hey, 65 cents premium we take in, and our risk is $1. Does that sound like something we may do? Absolutely. Now, somebody said something about assignments. Usually we go 2-3 weeks out. Okay? You're not going to get assigned till the last day of expiration unless the options are deep in the money. Okay? Why? Because the options still have premium. And if they have premium, they would rather get them at the supermarket than go to you. Why would they go to you and pay a fee if they can just go to the supermarket and get them from market, right? So you have premium on the option till the last day. We will liquidate the option the last day. Let's say you get exercised. Okay, you get exercised. What happens when you get exercised? What happens when you get? Let's just walk through it. You're long and short. You exercise your short. You get exercised on your short. You exercise your long. They cancel each other out. You keep the premium, and you pay your broker $10 extra in fees. So I just gave you the scenario. Remember, you have a call and a put, short. I mean, a long and a short. If your short is exercised, all you have to do is exercise your long. So if you get exercised at 73, you exercise your 72. You lose your dollar minus the premium. Here, where was that example I was giving you? I think it was right here. We were talking about puts, right? So let's say right here. Let's just say right here, 50. Right here. Let's say right here, 58.59. Okay. They're different. You have over $1 here. No, you don't. Yeah, you do. You actually have over $1. This pricing is not right. There's not a lot of liquidity here. But let's just say, hypothetically speaking, most case scenario, $1 here, we take in 50 cents. Okay, 40 to 60. That's 40 to 60% is our goal. So what happens when you get exercised? Okay, your 58 is exercised. You're now long at 58. Sir, you have a PayPal at $58 a share. Okay, can you exercise my 57? Yes, we can. You have a short 100 shares. The long and the short will cancel each other out, and you keep your $50 in premium. Okay, mea culpa, so big deal. It's a credit spread.
Yep.
Okay, so I just gave you the worst case scenario. You got exercised. You exercise yours. That's it. Remember, you're only $1 apart. You're only apart the spread minus 40 or 50%. And you're always keeping the premium no matter what. So your max loss is 40 to 60%. Your max gain is 40 to 60%. And we've been right 79% of the time. Just put that in your little calculator and do the math. Now, what we're also going to start doing, and we haven't done it yet because earnings season just started. Another strategy that we're going to be doing in this program is called diagonals. Diagonals are really, really cool. I call them anchor trades. Now, the reason we haven't started doing them yet is because you need to have earnings and then 3-4 days pass after earnings. And earnings just started. So we're just getting to the diagonals. Diagonals are really cool. Let me show you how diagonals work. So let's pick a smooth climber. That's a smooth climber, WDC. So let's just hypothetically say, let me show you this. You guys are going to love this. How do we exit the trade? Gus, don't ask somebody to marry you before you know whether they speak English or not. Okay? You're jumping. You're jumping way ahead, Gus. You're jumping way ahead. Judd did the trade and got 51 cents. Well, there you go. So your risk is 49 cents. If you're right, hypothetically, and I don't know if the trade's going to be right. I'm just using these as hypotheticals. If you're right, you'll keep your 51 cents. If you're wrong, you're going to lose 49 cents max. But we're right 80% of the time. So think about that for a minute. Eight out of 10 were right. So think about this. Let's do the math. 8 times 50 cents is $4, right? 2 times 50 cents is $1. So for every time you do 10 trades, if you could make $4 and lose $1 every time you do 10 trades, wouldn't that be great? That's $3 net, Raleigh.
I know. It's fantastic. It's amazing, Roger.
I'm giving you the formula. I'm teaching you exactly what we're doing, and I'm showing you exactly the whole thing. So do the math. Just do the math yourself. Our accuracy has been, not will be, has been 79%. And I take in 40 to 60%, which means my risk is 40 to 60%. Just plug that into your calculator. 8 times 50, average, 50 cents, and then 2 times 50. Not bad, right? So that's the credit spread portion. and you have limited risk. Your risk is limited to the difference between the spread minus the premium you took in. So let's say the spread is $2.50, and let's say you took in $1.20. Your risk is about $1.20 per spread.
What's really nice about this, in my opinion, Roger, is that what you're reinforcing here is you first looked at a stock that was giving you potential. That's what your focus is. And then you decide, how do I want to trade it? And in this particular case, you're going, I like this as an income trade. Under other circumstances, you might have just bought a call or done something else. But in this particular case, it all started with the fact that you're selecting a high quality stock, and now you're determining how to trade it. And I want people to understand that is that, without that, this falls apart. And the example, and Roger gave you example, guys. People are wondering, what was the strike price on PayPal? And what was the other one? Roger brought those up to make examples, guys. Okay. Don't get all focused in on, on that aspect. Sit back and just absorb what he's teaching you.
Yeah. Now, I've been telling folks all day in my Telegram channels, we're going to wait till the end of the day. I don't trust this market. Do you know how many people have already placed trades and been ignoring that advice? And we're right now near the low of the day on the SPY. People just don't listen. People don't listen to me. What can I tell you? You'll learn one way or the other, but I've been doing this a long time, and I have more patience. I have enough patience for all of us.
Yes, you do.
Think about this. I have a lot of patience. I have 8 pets and 3 kids. Got to have a lot of patience, right? Okay, so let me show you what a diagonal is. And
yes,
let me tell
this
you,
is interesting.
People are like, what? I've never seen these. These are so cool. So imagine the stock. Imagine you take AMD, a stock that's been going up, right? It's been going up. And imagine you sell a naked put here. Now, right away, when you hear the word naked, you're like, what? You're not telling me to sell a naked put. That's like the fastest way to the poorhouse. It is. I agree with you. It is the fastest way to the poorhouse. And I would never suggest you sell a naked put, but let me finish first. So you sell a naked put that expires this Friday, hypothetically speaking, of course. Okay. So let's say we sell the 221 put. Okay. 222. Let's just say 222 for $1.50. Okay. Then I'm going to go 6 weeks or 5-6 weeks, say 38 days out, and I'm going to do the exact same thing. I'm going to buy the 230 put or 225 put, and I'm going to spend $11. Now you're probably saying to yourself, Roger, that sounds kind of comical. You just said this is an income strategy. You just took in $1.50 and you spent $11. Sounds like you're still in the whole $9.50. I am. And usually the reason we wait for earnings is because the option the put option is still inflated. So we'd be able to do this type of spread for like $5 versus $11. That would be ideal. So let's just say we took in, but let's just say, hypothetically speaking, let's say we took in $1.50, okay? And we spent $11.50. And the option doesn't expire for 5 weeks. What I'm going to keep doing is I'm going to keep taking premium every week for the next 3-4 weeks till I've collected more than what I've spent for the amount of time that my option has decayed. Whoa, Roger, what did you just say? Let me repeat that. I'm going to hedge myself with an option that decays very, very, very slowly. And what I'm looking to get is this, and I hope to God you're writing this down. I'm looking for the options that expire in the next week or 2 or 3 to lose value faster than an option that expires in 6 weeks. Now you're probably thinking to yourself, okay, you're looking for an put option to decay faster than an option that will decay in 6 weeks. And you're probably saying, well, that's obvious. It's obvious that the option that expires in a week, 2 and 3 weeks is going to decay faster than the option that expires in 6 weeks, right? Well, guess what? Not only do they expire faster, but they decay 10 times faster. Like ice. It's like a little piece of ice versus a big steak that's been frozen for a year. My steak is going to take a long time to defrost. Okay. So let me give you an example. Let's just say, hypothetically speaking, okay, now I want you guys to write this down. Okay. Let's say we took $1.50 this week, we take $1.50 next week, and we take another $1.50 the following week. How much did we take in? We took in $4.50, right? Okay. Let's say now that my option that I bought and paid my good money for, the 210, oh, it's only $6.50. I thought for some reason it was $11.50. Let's say that this option that doesn't expire for another 38 days. So we took in $4.50, right? We spend $6.50, right? Okay. Let me see how much the 210 costs, just to make sure I'm not crazy. Yep. Okay. So here we go. 10 days to go. Or let's just see 3 days to go. The 210. Okay. 39 cents we take in 39 cents. And then the following week, we take in $1.50, and the following week we take in $4. But let's say it's only $1.50. Okay, so $3 plus 40 cents. We took in how much, Raleigh? $3.40.
40 cents. Yep.
Okay, how much did we spend out of our pocket? $6.50.
Yeah, $6.50. Yep.
3 weeks from now, how much do you think this option is going to cost? $4.50. So how much did I lose out of this option? $2. How much did I gain on the options that I sold? $4.40. That's twice as much.
Twice as much. Yep.
You just made over 100%. You just made over 100% return. Yeah. Yeah, only when they're in an uptrend. So what I'm trying to do is this. I'm trying to buy a hedge, a 100% hedge, same strike price as we sold, 6 weeks out, 7 weeks out. Okay? And I'm trying to buy and trying to sell premium that's going to expire like this, while ours expires like this. And I'm willing to make a bet that the premium that I take in will expire faster than the loss that I will take on the option that I'm long. Mm-hmm. And I'm willing to bet that it'll happen at a rate of about 3-1. And now you're probably thinking, shit, how come nobody else is doing this? This is pretty good stuff. We got to wait till it works best 3 to 5 days after earnings. So that's I'm waiting to start doing it. Yeah, because that's when. So I'm waiting to start doing them. Because remember, we just started last week. That was our first week. So I'm starting to get into the heart of earnings. So as soon as some of these stocks have earnings, implied volatility is still high. And sometimes we can sell those options for like $3 and buy a 1 6 weeks out because it doesn't have high implied volatility for like $4. So we barely have a debit to begin with, and we have all this. So we're like Pac-Man. We can eat all this. We can eat all this stuff. Okay, really, really good. Hold on 1 second. I want to.
So I just want to reemphasize something while Roger's looking at this. This is not a strategy that's applied randomly. It begins with what is the best stock. Okay, how do we want to trade it? And in this particular case on the diagonals, Roger finds that this setup can really favor those stocks that have already had earnings. Earnings have already come out. We're 3 to 4 days after that. So if you add that combined with the direction that the stock's moving on based on the technicals, those are the elements that, help Roger decide, is this a diagonal spread that I want to take? And Roger, I know that there's some cases where a stock can reward you twice. If you do a calendar spread before earnings and it works out for you, you profited on that. And now earnings are over and the setup is nice for a diagonal.
Exactly. That's exactly right. That's exactly right. How do you determine the DTE for purchase options? Rickster, we do the closest till. I forgot to tell you. You can only do the strategy on stocks that have weekly options, which is 90%, 90% of 90%. Hold on. Richie said to show them something. Oh, Richie said show them this. Here. See, slow time decay, fast time decay. So you're buying options that have this time decay and you're selling options that have this time decay.
Time decay. Yep.
But they're the same strike price. And so let's say I spent $10 here, but I take in $4 here. Well, by the time I liquidate the spread, I'll lose less here than what I've made here. This will decay much faster than this. And that's a scientific fact. Calendar and diagonal are very different. For diagonal, you have to have exact the same strike price. For calendar, you have to have the same strike price. For diagonals, the strike price the strike prices don't have to be the same. When we usually go one strike price below or one strike price ahead. Yeah. See how fast I am, Richie? Thank you for that. Thank you for that graphic. So your time decay is very, 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 very different. Okay. All right. So I just showed you two ways. That we take income in a program that we call weekly cash flow. Now, I love weekly cash flow. It is one of my favorite programs. It's very profitable. We make money in it. And we do these kind of trades. Now, these diagonals, we introduced these diagonals literally at the tail end of the earnings season, last earnings season. So we haven't done any yet since then because earnings season just started. And last week, earnings season started. And I usually, if you look at my notes for the diagonals, you will see that we do the diagonals. Like, let's say a stock has earnings today, I will start looking at the diagonal for that stock Thursday, Friday. So what I do is I do time spreads or calendar spreads leading into earnings, and then on the back end of that earnings, we do the diagonal. You understand? That way we can even get 2 for 1 sometimes on the stock, which is really fun to do. So we're just about to start the diagonal season because this is the first major week for earnings, and then so this is the time. This is why I'm doing this right now. But I wanted you to understand that diagonals and seasonality are really, really good, and they go together extremely, extremely well. Let me just
So let me jump in for a minute here also, Roger. For those of you that are watching this on YouTube, we're about to close YouTube because we're about to move into a promotional section here, and we can't do that on YouTube. So if you're on YouTube and you'd like to stay with us, just go ahead, and I think Matt will put a link in there inviting you to the Zoom room. Now, if you're already in the Zoom room, you're already on this chat panel, you don't have to do anything. You're good. You're here. The other thing is that, folks, a lot of you are asking for replay. The beautiful thing about Roger's VIP sessions and his morning sessions is that they're instantaneously recorded and they're available on his YouTube channel. So for those of you that would like to revisit what Roger just talked about on everything to do with spreads, time, diagonals, etc., just go to his YouTube channel, and I put a link there for you on that. And with that, Roger,